Hi, everyone. So we're starting our closing plenary off with a great panel, and we're going to sort of be talking about where do we go from here. We started the day by taking stock of sort of where we are, and now we're going to talk about where do we go from here. How do we scale new tools and accelerate impact? And so I am joined for this panel by Alex Petersen-Swane, who is the CEO of the Global Innovation Fund, Haye Schutte, who is the head of Financing for Sustainable Development Division at OECD, Dr. Tamsin Barton, who's the Chief Commissioner for the Independent Commission for Aid Impact here in the UK, Semya Ayubi, who's the Chief Economist for the Swiss Agency for Development and Cooperation, and Soren Peter Andresen, who's the General Manager for the European Development Finance Institutions Association. Thank you guys so much for joining me today, and thank you all for being here. I wanted to start with a question. Earlier this year, UN Secretary General Antonio Guterres said that we won't be able to finance the SDGs until the financial industry fundamentally changes. And so I want to start by asking whether you think that's possible. And if not, what do we need to do? And if it is possible, what will it take? You want to kick us off, Alex?
I'll take a shot at it. I'll actually give an example of the kind of thing that I think is well within our grasp. And the question a bit is how to scale it. The Global Innovation Fund recently made a loan to a company in northern Nigeria called Babangona, who work with smallholder farmers by giving them in-kind loans at the beginning of the planting season, technical support, and then wholesaling their product for them at the end. And okay, that's interesting. Debt finance for that company, that's a good thing. But what's interesting is how we did that. We gave that company and led around with other impact investors of subordinated debt where we explicitly took on currency risk. And then that allowed them to crowd in senior dollar-denominated debt on top of that from folks like the IFC. In addition to that, we gave a grant to Babangona to do a randomized controlled trial to measure their impact. If their impact on farmers' income exceeded 20% increases, we're going to reduce the interest rate on the debt that we loan to them that they have to pay back to us. So here's an example of blending, rewarding impact, deliberately spreading risk amongst different actors who can bear different kinds of risk. We can do more of this kind of stuff. What we need to do is folks on this stage need to be coordinating more, sharing more stories, and figuring out maybe how to take on a little bit more financial risk in return for outsized financial impact. I read somewhere recently that if the MDBs allowed themselves to go from a AAA credit rating to a AA, that would unlock hundreds of millions of dollars for development impact. We need to start talking about how we can really do that.
I think it's happening. I would take a positive view on this. A couple of days ago, I was, as many of us, at UNGA, listening to quite good discussions at the high-level dialogue on financing the sustainable development. And what I was struck was that, blending finance, something that we have been discussing about during today, is becoming mainstream. So we had both public, but also, and those are close to the OECD, obviously, but certainly a lot of very, very serious private sector players sitting there and saying, well, no longer we are thinking about it, we are intending to do it, but rather we actually already do it. And yes, I think still the figures are relatively in the big things of things small, but I think we still certainly see that the concepts and the ideas and the practice is actually changing. So I think certain ideas that were confined to the development finance policy wonks, like myself, I think are now really becoming mainstream. I think that's very, very positive. But going forward, we certainly need much more kind of a better knowledge. What does it actually take? So much more learning from practice, developing the right policies, having the right kind of data, having the right kind of partnerships, transparency in key issues. So there are many, many elements that basically need to fit together in order to really, if you like, transform the financial sector. But I think it's very much work in progress, and I'm happy to dwell on any of these aspects further.
I will come back to you on some of that, but Tamsin, do you?
Yes, thanks very much. So I'm from ICAI, which is the UK's aid watchdog. So obviously our normal frame of reference is a rather critical one. And as we embark on any of our reviews, we try not to set unrealistic ambitions against which to review our targets, if you like. So you're asking me to kind of step out of that in a way and look at the potential for transformation. And you're talking about huge transformation, which is changing markets into something completely different. So I would say we need to be careful to ensure that our ambitions are realistic and push it where the opportunities are. So we just heard from Alex about a really interesting pilot, which is opening doors for others to follow. I think the DFI system and the IFI system has the potential to do that. CDC, which is the most relevant review we did recently, I think has a really unusual potential because its key shareholder has said to it, we are lowering expectations for financial return. We're encouraging you to take more risk. So that is a real opportunity. If you've got an organization and the UK has injected into it 1.8 billion already of capital and considerably more expected. I think up to 8% of ODA is what ODI calculated. So there's something potentially transformative there, I would say.
Yes, I would like to share also perhaps an example from Switzerland. There's an initiative that we try to make the financial market more sustainable, or to give them incentives also to do so. And there was a self-assessment test, not mandatory, so volunteer, in 2017, where it showed that pension funds and insurance companies supported investments with a global warming between 4 and 6 degrees. So that's good to know, and that's also good to know for them. And we will repeat this probably next year, also to help them understand what's the issue. And I think there is a driver coming also from the demand, and demand is the investors, and investors to put the money on the bank, to put the money in pension funds, as we heard from Jeremy before, who wants to know where the assets are invested, also because they are looking for such investments more and more. And this will not change fundamentally the financial sector, but it will raise awareness that things can be done in another way. And there is a lot of opportunity, I think, most of all with climate finance, where is also a lot of interest. And I think we have to show also the opportunities to invest there. And this is still not a systemic change if they invest in climate change.
No, and I had the opportunity recently to interview the head of the Swiss DFI, and he told me that they have a dual mandate, and part of their mandate is to mobilize domestic capital in Switzerland, and that they're failing. That part of their mandate, they have not been able to mobilize the financial sector in Switzerland, which, as we all know, manages a lot of the world's capital. And so I think we can come back to that, but I think it's a critical question to be asking that, if the Swiss DFI is, he's telling, I'm a journalist, right? So most people try to hide things like that from me, but so if he's telling me, we're falling short as part of our mandate to do this, I think there are still fundamental questions. But Søren, I'll go to you.
Yeah, I think it's a very relevant challenge to say, how do we make the whole financial system more sustainable? As TFIs, we spend a lot of time sharing our data and experience to show the financial qualities in terms of risk and return of a portfolio in what the private financial institutions call emerging markets or frontier markets. But I think when you talk about sustainable finance and the really big flows to these target markets to make a difference, you have to really also look at what it means to make a sustainable investment. And I earlier this year, the Financial Times had an article basically showing a portfolio of public equities that was rated by on their sustainability content by the two of the leading international index providers, so big famous institutions that did this ESG rating of these portfolios. And for 500 companies, there was absolutely no correlation between what they each regarded as being a very sustainable investment. And we will fail if, as DFIs, we try and convince private institutions about the qualities of our market and ask them to convince their clients about the qualities of this market if we can't tell them, is what you're doing really climate finance? Is it really going to create jobs and opportunity in the markets you work in? If we can't do that, and we must, I think we stand a better chance than some of these rating agencies for the moment, but I think we really must be able to be convincing on that point. Otherwise, we will not mobilize to the extent that we need. And the private institutions won't be as professional as they need to succeed.
Yeah. So, Alex, I want to come to you and ask you where you think we need more innovation that can help us scale. And I know you guys have been doing a lot of thinking about sort of what's your role, where do you fit in sort of the life cycle of a company, where does your investment come in, how can you look to fill gaps, to fill the valley of death for certain organizations. So, you know, where do we need those sort of innovative vehicles, those moments of innovation, the innovation around systems, and so where should we be focusing on that as we are looking to scale?
Well, I think it's a great question that I'm sure colleagues here will also chime in on. I think that there's three places I would highlight. One is taking the riskiest piece of relatively large projects. So the example that I gave about Babangona earlier on is an example of that. In that particular debt financing round, raising a total of something like $50 million worth of debt, figuring out how to take a risky tranche unlocks other capital for that company. That's one. Number two, I do think that there is a valley of death in which companies have moved beyond friends and family. They have moved even beyond, seed financing and Series A, but are not ready to tap into local private equity yet, or even DFI capital yet, simply because of the ticket size that people are looking to raise. And we need vehicles that particularly have that mandate to be in that space because of the potential for outsized social impact, particularly as measured by job creation. Small and medium-sized enterprises, firms that employ 10 to 100 people, that's the vehicle by which we're going to get the kinds of jobs in South Asia and in sub-Saharan Africa that we're looking for to achieve the SDGs. So we need patient vehicles that don't need to rush for IRR and rush for exit, that can see those companies along their journey until they're ready to engage with DFIs. And we've just got gaps then in our financial ecosystem. The third place, and this I'd love to hear from my colleagues what they think about this, is we've got to figure out local currency working capital. And figure out how to have partnerships between folks like DFIs or even Treasury of the OECD countries and local banks so that lending can be done for working capital in local currency. Right now, we've got companies who are raising equity from people like Goldman Sachs, but coming to Global Innovation Fund saying, to really get our company kickstarted, we shouldn't use our equity for working capital. We need a particular facility for that. And I've got a tremendous amount of sympathy for that, but just not clear as an innovation fund, that's the right mandate for us. I'd love to be able to say, not us, but here's the right people who particularly have that mission, working capital in Nigeria. How can we create that? I don't know what you think about that challenge.
Happy to respond to that. So as the OECD, we're about better policies for better lives, basically. And we do so by convening various stakeholders, ideally the more diverse, the merrier, if you like. So one of the initiatives in the area of mobilizing private finance is the so-called Trihathakarana roadmap on blended finance. So Trihathakarana means 3 ways to happiness. Okay. It's Balinese. It was launched by the Indonesian government in Bali last year at their annual meetings. And it basically is a community of actors from private sector, from public sector, CSO think tanks that are working currently on 5 areas. One is, what is best practice, if you like? What can we learn actually from practice, but also from the failures? So practice is one issue. Secondly is the whole issue of commercialization, i.e. how can we scale issues without, probably undermining market development by over-subsidizing through public resources. The third one, is that's your area, is about building local markets, inclusive markets. Because what we know is currently the predominant model is obviously that funding is being transferred from abroad into local markets. And what we all know is that in order to make these kind of investments also sustainable, to create developments, you have to look into local capital market developments. The fourth one is on transparency, because we all know that we currently still lack the data really to make the case. So I'm a development banker like Søren is, and then you are. I think we have seen it happening, we are believing it. Do we already have the kind of data that both on the macro, meso, but also micro level really show that this is a very good business proposition and a policy proposition? Probably not yet. So transparency is really an absolute key to that. And in this working group, for example, colleagues are looking into what do we talk about, what kind of data do we need, what are the challenges that we are facing in being more transparent. And the fifth area is actually on impact. So the whole issue that was also discussed earlier today about how to develop methodologies, both to measure but also monitor impact is something that also this Trihathakarana roadmap is looking at.
Yeah, well, I don't know whether I'm the right one to follow on, but you've kind of thrown me the conversation. I think that the first things that occur to us, probably in answer to the question, are the areas that Alex was touching on to do with innovation and risk. And I should declare I do have a past in this world in having worked at EIB and EBRD. But I think where I am now, then the focus is very much on the important innovations required in transparency and impact monitoring and evaluation. I mean, I remember when I moved into the IFI world, one of the things that attracted me was that at the EIB there were very, very long-term projects. So you actually had a reason to be monitoring for 20 years what difference your investment made, which frankly isn't so often the case in the world of grants. But that isn't always taken up, and it's certainly if it is taken up, then it's not always transparent. I think there is still a long way to go in this. I think it's been important in order for some kind of impact monitoring and evaluation to move forward that the international financial institutions have collaborated. So you've got MDB group, you've got DFI group. So I'm a bit out of date. You can probably tell me there are many more groups. I understand from the ODI article that there is a slightly different approach from the OECD to those groups. So there's a bit of a challenge whenever you get collaboration. But anything that leads to greater transparency and more focus on what difference is it making at the end of the day would be the most important sorts of innovation, I think.
Just Søren, before you speak, because I'd love to also hear you talk about the following, which is how are we going to pay for that stuff? Traditional management fees do not cover the kind of impact measurement that DFID expects the Global Innovation Fund to do and to achieve those kinds of transparency goals around impact. So how are we going to grapple with that as a policy question or practically within management fees for the funds that we're investing in?
If that's addressed to me.
For either of you, yes. I don't know. I mean, maybe that's also something you're saying to CDC and DFID when you're thinking about this.
Well, very briefly, because I don't want to take up the time from the others. I do think within the DFI world, the publicly subsidized world, the money has to be there for this. Mm-hmm. The challenge is how you scale that up in the private sector. But I'm going to pass to you.
You cannot be an investee of a DFI, I think in part because of what our owners, the governments, expect. You cannot be an investee of a DFI if you don't agree to disclose the basic data of course, your financials, but also on how you responsibly run your company or your fund, or what kinds of impacts you're having. And the norm now is that you, of course, need to submit that upfront before the investment is made, but that you're also expected to contribute each year during the life of the investment. So you could say that the clients are paying to a certain extent, and the DFIs are processing the data at a basic level. But I think we have a huge public interest in having better understanding of how these markets are evolving, both on the finance risk side, but also on the impact side. And I think there's lots of people, maybe you can confirm that, Tamsin and Hai, but there's lots of people who'd like to invest with DFIs in trying to make more sense of the data that's emerging. I think that's for sure. I think we as DFIs now, and you mentioned the different groups, we have a huge responsibility to find a way to pretty fast harmonize the way that we call different things and measure different things. So today, honestly, many of our institutions co-invest a lot. Like in our group of 15 DFIs, half of the funds that we invest are with among two or more DFIs just in our group. And if you take the multilateral banks on top, it's even more. But when we come to approving an investment, sometimes we've had to be tolerant to say, well, one institution measures greenhouse gas emission effects one way, or even you measure jobs in different ways, the core measures of your success. And we have to, if we are to be credible also with private co-investors, we have to speed up the process of getting as close to each other as an industry as possible. And I think that's a big focus now.
Perhaps just on innovation. And we are a lot talking about blended finance and try to find new financing instruments. But I would say, which is also really important, is to have innovation with the projects themselves, and to try to focus also on the impact that we were talking about. And just I would like to share an example. We have created I would say, an innovative instrument, which is called social impact incentives. Think big is the acronym. And there we are just buying impact. So how does it work? Just briefly, for example, there is a diabetes clinic in Mexico, and they faced a problem that they could manage to finance it with a certain group of patients, but not with others who could not pay as much. So we finance this gap continually, and we're also talking with them in order that they could decrease costs by 30%, and 40% less costs that also allowed other investors to come in, to jump in, and the clinic was growing because they could also take in charge other patients, and so this was a successful story. So just this example to show that innovation could also imply other instruments, not only financial instruments. So I would say it's not only about blended finance, but perhaps also blended ideas, blended approaches, so to cover all of the whole aspects of the
and that's certainly an interesting model because it's using sort of a results-based financing model in the blended finance context. Mm-hmm. You can read more about social impact incentives on Devex if you want.
That's true.
To learn more. But I wanted to come back to something you said, Soren, because you talked about clients having to pay for some of the impact measurement work. And I think if we're talking about companies that are founded by, run by, founded in developed countries, maybe they have the additional resources to do that, but as we get into smaller companies, and if we're talking really about reaching into SMEs, in developing countries, as DFIs and others are looking increasingly to see how do we create the vehicles for investment in least developed countries, which I think everyone agrees is a place that more of this financing needs to go. Maybe that's not as reasonable to expect them to be able to pay for it. So I think there's a fundamental question about how do you right-size the expectations of what the impact measurement is, not just for bigger companies based in OECD countries, but how do you make sure that the company in northern Nigeria, in the future in Somalia, is actually going to be able to follow through and be able to get that investment. So I would throw that out. How do we ensure that not only the impact measurement, but as we're creating these standards, that we're not leaving behind those companies in developing countries that are going to be essential to moving this forward?
No, from my point of view, just briefly, I mean, that's very much true. I mean, you don't see, it's part of why you don't see a lot of DFIs being able to do the kind of work that Alex and her team are doing, investing directly in small companies. I mean, we try and reach those kinds of clients either through, occasionally through funds that we can support that have the capacity to do that. And fortunately, some DFIs can tolerate the risk to do that also in fragile states and so on. But often we do it by financing larger financial institutions, banks basically, in the local capital markets. And they have the capacity to lend local currency and so on. And of course, they have criteria that they need to follow to make sure that the basics are met, but they don't ask each individual client to report as intensively. But then that's why DFIs work a lot in what we call an intermediated basis and not directly. And it's very hard to do. Right? So the challenge is a true one, I think.
Right.
There are three things. I think one, there's obviously a case for public subsidies here for the time being, in order to put a basis, develop certain measurement techniques. I think the second one is standardization. So what Søren is telling about the EDVs, I mean, there are other groups also that are really pushing towards a common understanding as to what do we talk about when it comes to impact measurement and monitoring. So standardization then allows for lowering costs. I think the third one is also technology and data. I mean, that's a big game changer that I think we currently can capture more and more data that we couldn't before and process this data much more efficiently. So I see really that a lot of kind of different elements are coming together. And at times it's probably just to say we can't and we shouldn't. And we just maybe do it, having a deep dive every couple of years on a certain sector, on a group, do it very, very thoroughly, methodologically sound, and then step back and say that is probably for the time being good enough and it's not really made for this kind of clientele and that kind of country context that we can do it on a continuous basis. But these are policy changes, choices to be made.
Tamsin, did you want to?
Well, I don't have a huge amount to add, except that actually, as Søren was saying, a lot of the burden can be picked up very often by intermediaries, and I think it's too often been used as an excuse, actually, that the burden is too great. And in many ways, I thought that it's been a very useful corrective to any risk that the public sector crowds out the private sector, because it's brought with it all these obligations and made it very clear what all that money is for. So that's the only comment that I would add. But if public money is going in, then we need transparent impact information coming back.
But I also think it's a good challenge for entities like GIF who do have a particular mandate around this topic to right-size the level of this investment, to be challenged to say, how far can you go with getting us measures of impact beyond jobs created or something like that, while still keeping your costs low enough for this to be interesting. And need, to say, if you are going to do these sorts of deep dives and have your costs rationed, how can we get the most value for money out of that particular effort too? So I think that's a good challenge for entities like GIF that are a bit on the sort of, I hope it's not bleeding edge, on the sort of interesting policy edge of the sort of trading off social impact well measured for financial returns.
I think the big issue is obviously that we are, I think, in a fundamental shift where we have risk and return complemented by impact. I mean, I think that was a topic that came up this morning as well, and I think that's something we clearly need to push all collectively towards.
Correct.
It's being done by the big ones maybe first, or maybe by the smart ones very first, but I think then obviously it should spread. And what we know is obviously that those that have impact normally also the better ones on when it comes to the risk return kind of profile.
So I want to take a couple of very quick questions from our audience. I know our time is short. Do we have a microphone? We're going to start here.
Thanks a lot. I'm Tyler, Global Director for MSD for Mothers, which is a philanthropic initiative by Merck, the pharmaceutical company, to reduce maternal mortality across the globe. My question is, to what extent are we actually part of the problem in terms of the way in which our investments are guided in countries such as Nigeria, my own country, whereby we finance the status quo, or where we think that we can easily get our money back, versus what is transformative and the countries often need, which are perhaps sometimes a bit more difficult to navigate politically. I asked this question from an informed position, given some of the work that we've done in Senegal, where we've been able to sort of like invest in a supply chain system, reduce stock out to less than 2%, which was at 80% initially, but to get by using the third-party local private sector. But most of the supply chain on the continent are public sector supply chains, which are failing. They've been demonstrated to fail for many decades, but yet we still pour finance into the very same systems. So are we part of the problem?
Do we have another question? All right, we'll take that one, and then I have a final question I'd like to throw at you guys. So, as you answer that, another question I'd like to throw your way is, we spent a lot of time today talking about the current challenges. So what's an action that you think your organization is well positioned to take, or you think others in this space need to take, so that the next time we're all meeting on this stage, we're actually having a different conversation, and we've operationalized some of the new standards. We've improved the way we're looking at transparency. We've increased standardization so that some of these deals are easier to do. Hi.
Should I kick off? Are we part of the problem? We can, but we shouldn't, obviously. And I think the key issue, once again, is basically having transparency and then changing the kind of incentives in order to basically guide, maybe the public players away from doing the same that they have done before. One example, blended finance. Our data, Chris Clubb from Convergence this year, shows that it goes very much into one or two sectors. And we, I think, have a continuous dialogue to say, okay, renewable energy, we know it works. Guys from the public sector, step back, let the private sector take the lead here. If you do something really novel in that, that's okay, but don't really kind of repeat the transactions that have been done, rather focus on issues like health or other sectors. So maybe that's, are we part of the problem or not? I think we can be, but I think there's clearly, through more transparency and adequate incentive setting, ways to get away from it. As to your question, I like to, what we're currently at the OECD thinking is we have done quite a bit on mobilization, and I think the discussions today is testimony of that. Lots of questions to be solved, yes. There's some very good work by various players also in the room about impact measurement, but probably the thing that is somewhat new is SDG alignment. So I think we would like to shift the narrative from the billions to trillions narrative. That could be a self-defeating kind of narrative, but rather to shifting the trillions. Not from billions to trillions, but rather shifting the trillions. We all know there's sufficient money around there. And I think what we need to do is we not only mobilize more money, but also set policies, regulations, opportunities that will allow to shift commercial finance and link that to the SDGs, and then have the mechanisms and the methods in order to make sure that the money has a big impact. So, and that's something the OECD is happy to engage with other partners under the French G7 presidency.
I could take my cue from you. When you're asking, are we part of the problem, then I will consider myself part of the problem insofar as I'm part of the public finance system in some way. And I really agree with what you said. At the moment, we're not seeing the public finance go to where it's most needed. In the ideal world, there would be a perfect spectrum of allocation. And I think there is a great value in substituting loans and other financial instruments for grants in middle-income countries where there's still way too many grants going for the wrong reasons. But the most recent figures from ODI's paper show how incredibly limited the sums are that have been going to the low-income countries. I think it's 4% of blended finance on some combination of the data sets that they worked out. But you get the general picture. There's very little in low-income countries. And that's why CDC for us was such an interesting DFI, because the minister who changed its focus, Andrew Mitchell, he said, this is going to be the DFI that does the hardest deals in the hardest markets. Well, there's a few years to go yet to see if that's fulfilled. Our review felt it's not happening yet, and there's a long way to go.
Do you want to?
Yeah, I would like to, but please go ahead.
Okay. No, yeah, I would. I mean, on these 2 points, I think absolutely we need to recognize that a huge part of the challenge that DFIs need to help solve lies in countries that are a narrower set of countries that really need investment into their private sector, but that need very patient and risk-tolerant investment for a long time to come. And we need to be able to do that as DFIs, and I agree with CDC being an example of a DFI that has made that a priority and is working very hard to do more of that. I think it's a great study by ODI that Sam Attridge and the team did, but I would also say that it's got to be understood that we don't necessarily place at priority number one to get global asset managers to follow DFIs into those markets at the same pace that they would into climate finance in fast-growing middle-income countries. It's just more risky, and we need to solve the problems with the right tools. I think we need to be clear about that. I think DFI, at least the DFIs in our group, has the same proportion of activity into least developed and other low-income countries as ODA in general. And I agree everything could be lifted, but I think you have to be realistic about what you ask for, challenging and realistic. And just a quick comment on the point about are we reinforcing problems in the economies where we invest. I think sometimes that's maybe the most invisible part of what DFIs do, but understanding the clients that you work with and the political economy in the countries that you work in. And I think that's part of why DFIs are often seen as quite cautious, because it's incredibly difficult to sit in London or Brussels or wherever and completely understand the political economy and the health supply chains in Western Africa, for instance. And sometimes I think you have to be modest in how well you can understand the situations, and you need to work very closely with local partners.
I also like the idea to shift the trillions to other investments, and I think the climate finance would be a good opportunity. And for the other investments, I think it's particularly important also to be sure when we are talking about the risks, what are the risks? So there are entrepreneurial risks. They may be the same as in northern countries, unless that the people, there is less purchasing power. But as far as we know, startups may fail perhaps by 30%, as we were told. I do not have these numbers with own experience. But this may be quite normal that startups fail for a large extent. But then we have also, we try also to compensate this with the growth of those companies. Then there is another risk, and this may be a political risk when we have a fragile state. So we have the governance which is not, doesn't keep with the willing of the investors. And I think there is a lot to do also in part of political dialogue. And it is very important also to be close there and to have this political dialogue, and also to understand where things can be changed, also where is the political will. And this was the first panel on which it was mentioned that we have to see this political will also for reforms in order to make things change. And then, as have been mentioned, there is the currency risk, and this true currency risk can be covered, and there are some organizations I heard that do that, and I think this is great. And that's why also when we see this, when we make this, the 3 parts of the risk, we try to work closer with our DFI in order to tackle those risks.
I'll be brief. And just, thank you guys all for such interesting things to respond to. I'd actually start with our colleague from Nigeria, Merck for Mothers. I think, when we get to be a problem is when we're a hammer in search of a nail. And so let's say that, for example, I'm a person who I can make loans. And the outcome that I want to affect is maternal mortality. Okay, then I want to structure some kind of a vehicle where I'm making loans to reduce maternal mortality. And I don't know that I know the theory of change of how that happens, but that's the hammer I have, and so let me find a nail. And then, but in fact, if you look at the tools in the toolbox between the DFIs and the aid agencies and people like Merck, we can do lots of things besides make loans. We can pay for outcomes, and we can say, actually, what we want to do is do a good job of measuring maternal mortality and figure out how to pay for that outcome, along the lines of the incentive structure you were mentioning with the diabetes in Mexico. So I think what one of our challenges is, given that we're sitting in London or Brussels or whatever, is the humility of paying for the outcome we want, not wielding the hammer that we're most comfortable holding on to. In terms of GIF and what contribution I hope I'm able to say that we've made some progress towards a year from now when we're sitting here is continuing to move that needle on measuring impact and reducing the cost of doing that in a scalable, less sort of boutique fashion, so that we're not talking about, well, that's great that little impact investment funds that deploy $20 or $30 million a year can do this. What can we do when we're deploying $200 or $300 million a year that's still meaningfully measuring the impacts we care about and monitoring them over time? So hold me accountable for that. See if we make any progress towards that a year from now.
Well, thank you all so much for joining us. Please join me in thanking our panelists.